You've probably noticed some changes lately. Your mortgage rate quotes from the bank have quietly dropped, while the returns on your savings accounts and investment products keep sliding down. This isn't coincidence. On October 30th, 2025, in the early morning hours Beijing time, the Federal Reserve announced another rate cut of 25 basis points. This marks the fifth cut in just over a year. But here's what's unusual about this one. The vote was 10-2, with 2 dissenting votes sitting at completely opposite ends of the spectrum. One thought the cut was too small and pushed for 50 basis points instead. The other voted against any cut at all. When the world's most powerful central bank can't even reach internal consensus, what exactly is this rate cut trying to balance, and how will this struggle reshape your wealth? To understand why this vote split the way it did, you need to grasp the impossible choice the Fed is facing right now. On one side, there's inflation. September's CPI data shows US inflation still hovering around 3%, a full 50% higher than the Fed's long-term target of 2%. That's not a number you can brush off. History shows us that every time inflation spirals out of control, it takes massive economic pain to fix it. This is exactly why Kansas City Fed President Jeff Schmid voted no. His logic is straightforward. He believes current monetary policy is only slightly restrictive, and cutting rates now would be letting down our guard, potentially allowing inflation to roar back. On the other side, there's employment. While unemployment numbers still look decent on the surface, job creation has already fallen below the break-even rate. In other words, the job market's expansion can't keep pace with labor force growth anymore. That's an early warning sign of economic slowdown. Governor Myron voted against the decision too, but for the opposite reason. He thinks 25 basis points simply isn't enough, and the Fed should be more aggressive to support the economy. This is the Fed's classic dilemma. You use high interest rates to crush inflation, but you have to accept the risk of a weakening job market. You cut rates to protect jobs, and inflation might come back. In theory, the perfect solution would be to wait until inflation is completely cooled before cutting. But in reality, waiting could mean missing the optimal window. What's even more telling is the structure of that 10-2 vote itself. Not 11-1, not 9-3, but 10-2. This means the vast majority chose the middle path, but the divisions at both ends have grown too wide to reconcile. Hawks see the risk in inflation, doves see the danger in unemployment, and Chairman Powell, sitting in the middle, chose an answer that satisfies no one completely. But that's not even the worst part. What really makes this decision feel like a gamble is that they can't see the full picture. The US government shutdown has been dragging on for weeks now, and massive amounts of economic data simply aren't being released on time. Under normal circumstances, the Fed would base its decisions on complete employment reports, retail sales figures, manufacturing PMI, and a whole series of hard data points. But this time, that data is either missing or incomplete. You can spot the hints in the Fed's policy statement. They unusually used the vague phrase "based on available indicators" twice. That's essentially admitting they're working with incomplete information. Making decisions under these conditions is fundamentally placing a bet on the future. There are 2 ways to play that bet. One is to stay put and wait until the data is complete before acting. The other is to make preemptive adjustments based on incomplete information. The Fed chose the latter. The reason comes down to monetary policy's inherent lag. Rate cuts today won't show up in economic data for several months. If you wait until the data clearly shows the economy is in recession before cutting rates, you're already too late. That's why central banks often have to act ahead of the curve, responding to problems before they're fully visible. This is what economists call preventive rate cutting. But preventive cuts carry a fatal risk: getting the direction wrong. If the economy isn't actually that bad, your rate cut becomes unnecessary stimulus that could reignite inflation. If the economy is worse than expected, your cut might not be enough. Right now, with data missing, even judging the direction has become difficult. This explains why the vote split the way it did. When information is incomplete, everyone's risk assessment amplifies their existing positions. Hawks worry more about the inflation risks they can't see, while doves get more anxious about the job market crisis lurking in the shadows. The Fed's choice of 25 basis points is essentially risk hedging. It's not aggressive enough to trigger inflation concerns, but not conservative enough to miss the window. Even more critical is another major decision the Fed announced. On December 1st, they're stopping quantitative tightening. Maturing Treasury bonds and mortgage-backed securities will no longer be passively reduced from the balance sheet, but reinvested instead. This means monetary policy isn't just shifting from tight to loose, it's transitioning from contraction to expansion. This sends a signal even more important than the rate cut itself. The floodgates of liquidity are wide open now, and how will this money reshape the entire economic system? What's the essence of a rate cut? It makes money cheaper. When interest rates drop, the cost of capital across the entire economy falls. But this cheaper money doesn't distribute evenly to every corner of the economy. It flows to wherever returns are highest. After the Fed announced the rate cut, the S&P 500 hit new all-time highs for 3 straight days, breaking through 6,900 points for the first time. Nvidia's market cap pushed close to $4.9 trillion. Gold prices rallied after a brief pullback, with Shanghai gold futures approaching 900 yuan per gram. These are all signals of abundant liquidity. The money is out there, looking for a home. Why tech stocks? Because tech companies' valuations depend heavily on discounting future cash flows. The lower the interest rate, the more tomorrow's money is worth today. If a company expects to earn $10 billion in 10 years, at a 5% rate, that's worth only about $6.1 billion today. But at 3%, it's worth $7.4 billion. Rate cuts essentially add leverage to growth stocks. Why gold? Because gold doesn't generate interest, so its appeal depends on opportunity cost. When keeping money in the bank earns you 4% interest, holding gold means giving up that 4%. But when interest drops to 3%, gold's opportunity cost falls. Add in inflation expectations and safe haven demand, and gold becomes a refuge for capital. But traditional manufacturing and consumer goods industries look pretty flat by comparison, because their growth depends more on real economy demand than on capital costs. Rate cuts make borrowing cheaper for them, but if consumers aren't buying, cheap money can't create profits. This divergence reveals a deeper issue. The liquidity from rate cuts first benefits financial markets, not the real economy. Money circulates within the financial system, pushing up asset prices, but transmitting to business investment and consumer spending takes much longer. This is why stock markets react immediately, but economic recovery arrives late. And this transmission lag determines who wins and who loses in a rate cut. The impact of rate cuts is layered, and different players experience it completely differently. For businesses, rate cuts first reduce financing costs. If a manufacturing company needs to borrow $100 million to expand capacity, a rate drop from 5% to 3.75% saves them $1.25 million in annual interest. That money can go into R&D, expand production, or flow straight to profits. But here's the question. Does a rate route actually stimulate businesses to borrow? Not necessarily. If companies don't have confidence in future demand, they won't expand investment no matter how low rates go. This is what economists call a liquidity trap. You make money cheaper, but businesses don't want to borrow it. For financial markets, rate cuts are a direct positive. Bond prices move inversely to interest rates, so rate cuts make previously issued high-yield bonds more valuable. Stock markets rise both because discount rates fall and liquidity increases. But how much of this rise comes from improving fundamentals versus liquidity-driven momentum? These are two completely different logics. If it's only liquidity pushing prices up, bubbles are forming. For international capital flows, Fed rate cuts weaken the dollar's appeal. When US dollar rates decline, global capital seeks higher-yielding markets, and emerging markets might see capital returning. But this cuts both ways. Capital inflows can bring growth, but capital outflows can trigger crises just as easily. Countries with large external debt and fragile economic structures might actually see their risks exposed during a rate-cutting cycle. For ordinary people, the impact is most complex. Homeowners with mortgages see their monthly payments ease up. On a $3 million mortgage over 20 years, a 1 percentage point rate drop can reduce monthly payments by nearly $1,000. But at the same time, savings and investment returns are shrinking. If inflation runs at 3% and savings rates are at 2%, your money is actually losing value. Rate cuts favor borrowers and hurt savers. The same policy hits young people and retirees in opposite ways. The deeper impact lies in asset allocation. Rate cuts make cash less attractive, so people hunt for higher returns elsewhere. But when everyone rushes into the same asset class, risks accumulate. This is why every easing cycle gets followed by bubbles in some asset class. Before 2008, it was real estate. In 2021, it was tech stocks and crypto. There's another long-term impact that's easily overlooked. Rate cuts distort resource allocation. When money is too cheap, some inefficient companies that should have been eliminated by the market can survive by rolling over debt with new debt. Economists call these zombie companies. They tie up resources without creating value, dragging down overall productivity. Japan's lost 3 decades had one major cause. Long-term low rates kept too many zombie companies alive. This is the essence of monetary policy. It doesn't make everyone better off. It transfers wealth between different groups, searching for balance between short-term stimulus and long-term distortion. Your mortgage payment dropped, your investment returns fell, and your stock portfolio might be in the green. These changes seem isolated, but they all come from the same source. Rate cuts aren't a numbers game. They're a systemic redistribution of wealth. Money flows from savers to borrowers, from fixed income to risk assets, from the real economy to financial markets, from developed economies to emerging markets. That 10-2 vote at the Fed didn't just expose internal divisions. It revealed the impossible trade-offs between inflation and unemployment, short-term and long-term, stimulus and distortion. In the fog of missing data, they chose preventive rate cuts, betting the economy can soft land with loose policy as a safety net. But the cost of that bet will be validated by markets, borne by businesses, and shared by every ordinary person. Liquidity is like water. It always flows to the lowest point. Understanding this transmission mechanism helps you see why some people's wealth grows during rate cuts while others get diluted without even realizing it. Because in this global asset restructuring, what really matters isn't how cheap money gets, but which side of the wealth flow you're standing on.